When investors search for top-performing ETFs to add to their portfolios, they often start with familiar lists of funds known for their reliability and performance. However, focusing solely on popular choices can lead to missed opportunities. So, in today's video, we'll explore 3 of the best ETFs that you can invest in with confidence. So, how impressive and interesting are they? And well, can they give you a potential return? Without further ado, let's see. ETFs, or exchange-traded funds, are a fantastic way to diversify your investment portfolio. Think of them like baskets of assets, stocks, bonds, commodities, all traded on stock exchanges just like individual stocks. So, what makes ETFs so appealing? They track the performance of specific index, sector, or commodity, giving you a broad market exposure without the hassle of picking individual stocks. They offer some great advantages over mutual funds. First, they're traded throughout the day at market prices, giving you more flexibility. Plus, their expense ratios are usually lower because they're passively managed. This means they aim to mirror the performance of an index rather than actively selecting stocks, which keeps costs down and boosts your net returns. They also give you the advantage of diversification, a key to any solid investment strategy. By investing in a single ETF, you spread your risk across multiple assets. If one stock in the ETF underperforms, the others help cushion the impact, stabilizing your returns and reducing risk. This built-in diversification makes ETFs a smart choice for many investors. ETFs are also ideal for long-term investing. Their cost efficiency and broad exposure make them perfect for a long-term strategy. Over time, the power of compounding, reinvesting dividends and capital gains, can significantly grow your investment. Many broad-based ETFs have shown consistent growth over the years, making them a reliable option for building wealth steadily. Now, let's look at the criteria we used to select our top 3. Choosing the right ETFs for your portfolio means focusing on several key factors to match your financial goals and risk tolerance. Let's break these down, starting with income generation. Look for ETFs that provide a steady income stream through dividends. These funds invest in companies known for paying regular and often increasing dividends. This is especially attractive for retirees or anyone wanting passive income. Check the dividend yield and see how much income you can expect relative to the ETF's price, and track the growth rate of these dividends over time for future income potential. Another critical factor is capital appreciation. This is all about the ETF's value increasing over time. If you're aiming for long-term growth and are okay with more volatility, focus on ETFs in growth sectors like technology or healthcare. Review their historical performance and consider the future prospects of the sectors they cover, as well as broader economic trends that might affect them. A well-balanced mix of investments within an ETF is also vital. A well-diversified ETF spreads risk across different assets, sectors, or regions. This reduces the impact of any single investment's poor performance. For instance, an ETF with stocks from various industries is generally less volatile than one concentrated in a single sector. So ensure the ETF's holdings align with your risk tolerance and strategy. Cost efficiency is another essential criterion when selecting ETFs. One of the big advantages of ETFs over mutual funds is their lower costs. ETFs are typically passively managed, aiming to replicate an index performance, which keeps expense ratios low. Lower fees mean more of your money stays invested, boosting your returns over time. Compare ETFs based on their expense ratios and watch out for additional costs like trading fees. Finally, the stability and past performance of the ETFs should be considered. While past performance is not a guarantee of future results, it can provide insights into how the ETF has navigated different market environments. Look for ETFs with a consistent track record of performance over multiple years, especially through various market cycles. With that said, let's jump straight into the 3 best ETFs. Schwab US Dividend Equity ETF SCHD. Let's start with the Schwab US Dividend Equity ETF, or SCHD. This ETF is a favorite among investors looking for a mix of income and growth. Launched in 2011, SCHD tracks the Dow Jones US Dividend 100 Index, focusing on 100 US stocks with a strong record of paying dividends, solid financial health, and potential for long-term growth. SCHD's strategy is simple: invest in companies that consistently pay dividends. To qualify, a company must have paid dividends for at least 10 consecutive years, ensuring stability and reliability. This approach helps to mitigate the risk of investing in companies that might cut their dividends during tough times. Financial health is also crucial for SCHD. The ETF only includes companies with a market capitalization of at least $500 million, ensuring investments in established, stable firms. Additionally, a minimum average daily trending volume of $2 million is required to ensure liquidity, allowing the ETF to buy and sell shares without significantly impacting prices. The financial health of the companies in SCHD's portfolio is further assessed through various financial metrics. These include dividend yield, dividend growth rate, financial health, and return on equity. SCHD's current dividend yield stands at 3.47%, providing investors with a steady stream of income. The ETF also boasts a strong 10-year average dividend growth rate of 10.90%, indicating that the dividends paid by the companies in its portfolio have been increasing over time. This combination of yield and growth makes SCHD an attractive option for investors seeking both income and potential for capital appreciation. Since its inception, SCHD has delivered solid returns, outperforming many other dividend-focused ETFs. If you invested $10,000 in SCHD, you could see substantial growth over time. Assuming SCHD maintains its historical average annual return, a $10,000 investment could grow to around $13,800 in 5 years, and nearly tripled to about $30,640 in 10 years. This combination of income and growth potential makes SCHD a strong choice for long-term investors. Invesco QQQ Trust, QQQ. Next up is the Invesco QQQ Trust, or QQQ. This ETF is incredibly popular, tracking the NASDAQ 100 Index, which includes 100 of the largest non-financial companies listed on the NASDAQ. Known for its tech focus, QQQ offers exposure to some of the world's most influential and high-growth companies. QQQ's holdings includes giants like Apple, Microsoft, Amazon, Alphabet, and Meta platforms. These companies are leaders in innovation and have shown robust financial performance. The NASDAQ 100 is market cap weighted, so the largest companies have a significant impact on the ETF's performance, providing substantial exposure to the booming tech sector. When it comes to performance, QQQ works miracles. Over the past decade, it has consistently delivered an average annual return higher than many broad market indices, including the S&P 500. In the last 5 years, QQQ has averaged around a 22.4% annual return, making it a top choice for those seeking capital appreciation. Historically, QQQ has weathered various market conditions while maintaining impressive growth. Over the last 10 years, it has delivered a total return of over 177%, outpacing many other ETFs. This resilience and high performance makes QQQ a strong contender for long-term growth. If you invest $10,000 in QQQ, the potential returns are significant. Assuming QQQ continues its historical average annual return of 18.2%, your investment could grow to about $19,100 in 5 years and could more than quadruple to around $52,750 in a decade. These projections highlight QQQ's strong growth potential. Vanguard Information Technology ETF, VGT. This one is perfect for those who believe in the long-term growth of tech companies. Managed by Vanguard, this ETF focuses exclusively on the technology sector, covering areas like software, hardware, semiconductors, and IT services. VGT's expense ratio is a low 0.10%, which is great for investors since more of their money stays invested. The ETF tracks the MSCI US Investable Market Information Technology 2550 Index, including a range of tech companies from large cap giants to small firms with significant growth potential. VGT's historical performance is impressive. Over the past decade, it has delivered an average annual return of around 19.13%, significantly outperforming many other ETFs. This strong performance makes VGT an excellent choice for those seeking substantial capital appreciation. The ETF also offers a modest dividend yield of around 0.73%, with a strong dividend growth rate of 14.36%, adding an extra layer of return. If you invest $10,000 in VGT, assuming it continues its average annual return of 19.13%, your investment could grow to approximately $11,913 in 1 year, $23,500 in 5 years, and an impressive $55,750 in a decade. Over 20 years, that investment could soar to nearly $311,500, highlighting the power of compound growth in the tech sector. This is why VGT is a solid pick for long-term investors focused on growth. Now, let's compare all three. When comparing the three ETFs, Schwab US Dividend Equity ETF, Invesco QQQ Trust, and Vanguard Information Technology ETF, it's essential to look at their dividend yields and growth rates, historical performance, and the balance of risk and reward they offer. SCHD is designed for income generation with a current dividend yield of 3.48% and a solid 10-year average dividend growth rate of 10.90%. This makes it an attractive option for investors seeking a reliable income stream. In contrast, QQQ and VGT have lower yields at 0.62% and 0.73% respectively. However, their focus is more on capital appreciation, with QQQ's dividend growing at 9.93% annually, and VGT boasting a robust 14.36% growth rate. While SCHD provides a steady income, QQQ and VGT offer the potential for high growth rate in dividend payouts over time. In terms of historical performance, QQQ and VGT have shown remarkable returns driven by their tech-heavy portfolios. Over the past decade, QQQ has delivered an average annual return of around 22.4%, while VGT has achieved approximately 19.13%. These impressive figures highlight their capacity for substantial capital appreciation. SCHD, though primarily income-focused, has shown solid performance with its mix of high-quality, dividend-paying stocks, providing a balanced approach between growth and income. Assessing the risk and reward, SCHD presents a more conservative option with lower volatility due to its focus on established dividend-paying companies. QQQ and VGT, being heavily weighted in the technology sector, carry higher risk due to the inherent volatility of tech stocks. However, this higher risk is accompanied by the potential for significant rewards, as evidenced by their historical performance. Investors seeking growth might favor QQQ and VGT, while those looking for stability and income lean towards SCHD. However, when combining the three ETFs, SCHD, QQQ, and VGT, each offers unique advantages whether you're looking for income, growth, or a bit of both. By understanding their strategies, performances, and potential returns, you can make an informed decision about which ones best fit your investment goals. So, what do you think about these top-performing ETFs? Are you ready to make them a part of your investment strategy? Comment below with your thoughts, and don't forget to give this video a thumbs up if you found it helpful. Also, make sure to subscribe to our channel and turn on the notification bell for more insightful videos on investing.